How's it going, guys? Here's a feedback that I had in terms of what do I do in this bull market? Everybody knows when the market's down, you buy the dip, But what am I gonna do when Soxel is running up at 35 plus, and I want to participate in this bull market? Well, that kind of got me thinking, okay, how can I make it so that you guys are able to participate in this bull market? And we'll use Soxel as an example. Right now, the current price is at $35. We're at 3 o'clock, so we're pretty much at power hour right now. So let's see if we can catch this tail end of this. So I'm using my IRA account right now. As you can see, I have a few positions already on. Let's go for a 30-day position, and then we'll just review sort of what we already know. We already know how to conduct a Jade Lizard, and let's say, for example, the lowest price I'd probably go for would be 30.50 for being assigned, if I were to be assigned on 100 shares. And then I mentioned before, you can make it as wide as you possibly want. Let's say, for example, $40 is going to be a psychological level. Once it hit $40, I think there will be some pullback. I'm just making this up, whatever your thesis may be. And this is the current Jade Lizard setup, right? We got our nice big fat profit margin right in this band right here, and then we have the smaller band right here in case it runs away. Well, what if you want to participate and it keeps running away and it goes to $40, it goes to $50, it doesn't matter, within this 30-day time span? So I would say that if you're going to sort of commit to that kind of time frame, and that it'll run up that particularly large, I would recommend doing what I am coining. I don't know if this already exists, but I just sort of played around with it, and I'm gonna coin it as the Tanuki. If before it was a Jade Lizard, right, then we're going to do a Tanuki. And why a Tanuki? Because Tanuki's got big, fat balls. Okay, and so why does that matter? Well, we're taking our Jade Lizard where we have that middle ground strangle like upside, and then we have a tail end, right, the tail of the lizard being much smaller in terms of profit, and then what we're going to do is we're going to just add another call position further out into the money, and we're just going to position that call pretty much until we hit a relative sweet spot, so that way we can make this tiny $16 loss if in the event that you forget about the position and you just let it run to expiration, to approximately a green zone. So that's a dollar loss, so that 49 would be there. Okay, perfect. Now we got the setup that I'm looking for on the Tanuki. And so now we have only $100 strangle like upside in this range between $29 all the way up to $40, which is exactly what I had my thesis on before in the original Jade Lizard. But in the event that it runs away from you, your second call option that's all the way out at the $40 out of the money call is going to basically give you upside protection all the way out to infinity and beyond. And then the worst case scenario, you hit the snooze button for an entire month and it lands somewhere around here. The most you could make is $5, which would be just like having a Jade Lizard, except now you have this upside protection. And the reason why that is different than just simply having a Jade Lizard, pretty much during this time period, like what is it that you're supposed to do during this time period, is that this is all pretty much the extrinsic value that is left in that long call, in that long position. So if you were to keep all four of these legs in play, the profits from the Jade Lizard essentially pays for the entire call option, out of the money call option for that long call. So even if the profit, or even if the actual entire position were to go to expiration, you could still make $2 out of the entire position with this last $49 out of the money call position totally paid for, even though it's at zero, $0 of value. That's pretty much sort of where you have your break even. But if the stock does run up, and let's say it runs up in 1 day, 1 week, in a shorter time period where you still have extrinsic value left to it, you can close this entire 4-leg position and then basically capitalize on that upside run. Or you can just close the long call position, right, which is increasing in value, increasing in value up to that point wherever you feel like, even before it hits that run, and just simply keep the original Jade Lizard if you feel like it'll pull back afterwards. So that, I feel like, will give you a bunch of flexibility in terms of like, oh man, the stock market just keeps running, and I don't get any additional gains. Okay, I hear that. And so if you want to, you can join your degen like brethren in terms of being able to try to aim for a long call with literally zero down up call risk. And then at the same time, if you are completely wrong about that situation, or you're just sleeping on it, you effectively get zero downside movement, but your whole position is flat and you've wasted your entire month essentially doing that. Because $3 in 1 month, that's like losing $3 in inflation, basically. Gaining $3 is basically you just met with inflation at that month. But again, this will require more management as a result. You have to keep an eye on this, right? Because you now have a long or bought call position that is decaying over time. So you really have to be certain that this long position that you're thinking of is truly a long position in a short period of time. So in this bull run-ish type of situation, you can basically go ahead and say, all right, I want my 104 credit for that type of position. The amount of buying power that is going to be taken would be pretty much the same exact as a Jade Lizard. It doesn't add any additional buying power. In fact, it just makes it net neutral when you buy an additional long call position. Let me just validate that. So I've removed that call right there, hit there. Yeah, it's roughly the same. Your buying power effect is only the amount of money the entire long position is called it takes. So if you add that long in there, slap in that 49 right there. This isn't even really the ideal, but yeah, I mean, it's a now or never kind of deal for the sake of this example. And then we'll go ahead and review it afterwards. So $3 right there. I just lost $1 in credit because of the decay, and another $1 in credit because of decay. That's exactly what happens. And so let's just lock it in for $1 in credit for three grand in buying power. There we go. So now we have that position there. It just has to get filled. And yeah, this will be I'll have to ignore this 28. We can know that it's not part of this 28.5 put that I have over here. And so that's totally fine. Absolutely fine there. And then we'll just leave that and let that cook. Okay, so hopefully that helps in terms of giving you bullish positions. I would say that if you truly thought that you wanted to have a bullish position, but without like the downside risks, I mean, there not many that actually work in the way that we are, but this in particular still complements the wheel strategy in the sense that your downside risk is assignment at $30. And so as long as you're accepting that that's going to be the case, then quite frankly, this kind of makes up for it. But again, As time goes on, check out this calendar. As the days go on, see that dotted line? It just gets flatter and flatter and flatter. And so your assumption in a month time period has to be incredibly correct for you to benefit from that. And plus, look at the run up. It's got to move a solid, basically, I would say like 50+%, right? That the move up has to be incredibly dramatic in order for you to truly benefit from that in that regard. You can play with it so that your second call position is much closer, but there's going to be like a negative dip in that. So let me show you what I mean by that. So let's fire up that position again. This time I'll make it, was it 30 or 35? 30.5. And then I said $40 is my, and let's say I make this tighter. Let's say I buy the call over on this side. Now because of that, right, the closer at the money call that you're buying, oopsies, should have not done that. Let me just do this. The closer at the money call that you're buying is going to really flatten out your P&L in basically at the money area. So effectively what it's doing is that it's basically paying for a long position, and you get a $20 credit so you get paid $20 to just basically have a long position, but your P&L is much flatter. So that means that, again, it would still have to run up to about $42-ish, $43-ish, which is like a solid $7 move, $6-7 move in a month to really be able to just start to generate profits that are $200 and something. That's like basically the equivalent of 2 Jade Lizards being, within the sweet spot. Okay, yeah, you might be able to benefit from that. But at the same token, you got this little red P&L position right here. This little area where the call position is basically bleeding more money than the money that you make from the strangle portion, right? The puts and the call vertical that you have to effectively create this this dead zone. So that's why a zebra would just make sense if you just simply wanted to think bullish. A zebra is just a call position that is backed up with a short call position. Oopsies. And the goal is that you want to create basically a 100 delta synthetic position. What that means is, why is there no delta here? Why give me delta? That can't be right. How can there be 0 delta? There we go. So let's say we do a 73 delta long right here, and you do 2 of these, and then you do 130 delta short. And so what this does is that it synthetically creates the equivalent of you holding 100 shares of this stock, basically, from here on out. And what this allows you to do is that it allows you to have 100 shares of the Soxel. And then this position, this type of options position, makes more sense to just simply buy 100 shares than for you to try to do this with options. But at the end of the day, it's actually still relatively cheaper. You look at the cost right here. It would cost you $959 in debit versus trying to do 100 shares at $3,500. So the buying power required for this kind of long bullish position, which is the equivalent of holding 100 shares, but for a duration of 31 days, it's the same thing. The only difference is that you do have downside risk, 100% downside risk. There's no going out of it. Why? Because of the fact that, let Let's see if I can try to get that back again. Why is that? It's because of the fact that you have a call position that is effectively renders worthless if it never hits your strike price. And you only create this position if you want to define risk strategy that you're not assuming that you want to hold until expiration. This is purely just to ride the momentum up, close the position for a profit, and then walk away. The short call on this position is taking away that synthetic theta decay. So whereas you get theta decay from the stock just holding put and staying put in general, the short one position here in the zebra effectively allows you to not have to deal with that. And this isn't a 100 delta position. I'm pretty sure of it because it should be more like this, where this red line where the actual stock price is more along the lines of the actual stock price. There we go. And then I would assume that this probably is more like that. Yeah, there we go. It's probably here. I can't see total delta because Thinkorswim doesn't let you do that. So I'm just guessing. On Tasty Trade, it allows you to do that. So it looks more like this. So stock goes up, you benefit from the move up. But you only benefit from the move up. Because if the stock goes down, you're losing the same amount of rate of decay or rate of price loss, the same as if you were to buy the stock at exactly 35.91 and then it moved down 5%. If it moves down 5%, then whatever that loss is equivalent to the same 5% loss that you have on your, and now it's $1,500, which is still cheaper than having $3,500 of owning 100 shares of the stock, but effectively it's the same thing. So yeah, there's, but for the most part, let's go back to Tanuki. I think this makes the most sense for, again, us who want to have our cake and eat it too, right? To have our cake and eat it too, you say, okay, I'm going to be okay to be assigned 100 shares, but simultaneously give myself as much breathing room as possible. So maybe because of the Tanuki being so forward looking, I can probably shorten the strikes of the call vertical and then go ahead and slap in my long call. And so that effectively makes my position here actually less profitable. But yeah, that long position is actually still, let's see here. Yeah, that just gets stretched out. Yep. So yeah, so to get my long position closer by $2, I have to I had to move that around. But here it is. This is the sweet spot. So I'll make $100 if it stays anywhere between this range. And then if it keeps moving here, I have some upside potential. But again, you would have to manage that accordingly. So let's give that a whirl. Let's see if it fills. All right. Any questions? Just feel free to reach out to me. Take care.